All right, welcome to this explainer. Today, we are basically putting on our detective hats to tackle one of the most universal and, honestly, kind of frustrating accounting headaches out there: bank reconciliation. Because look, when your company ledger and your actual bank statement don't match up, you aren't losing your mind. It is just a mathematical mystery, and we are gonna solve it together.
Seriously, logically speaking, your ledger and your bank statement should mirror each other perfectly, right? But they almost never do. And the main culprit? It's almost always just timing. You know, that annoying little delay between writing a check and the bank actually processing it. That creates a temporary mismatch, and we have got to bridge that gap.
And to bridge that gap, we use what's called a bank reconciliation statement. Now, in official terms, this is a statement prepared by an entity to reconcile the cash and bank account balance in the entity's books versus the balance reported by the bank. But simply put, it's just the document that proves mathematically why those two numbers are different in the first place and brings them right back into harmony.
Okay, so here's our case briefing for today. We're going to dive right into the mismatched balance mystery, gather our clues by looking at ledger and bank rules, and identify our suspects, the reconciling items. After that, we'll open up the toolkit to check out 3 different reconciliation methods, apply them to a real-life case study with Sunny Company, and wrap it all up with the visual matching process. Let's get into it.
Part 1. Gathering the clues. We really need to understand the ledger versus bank statement rules before we do anything else.
Now, what is actually super interesting here, and honestly a bit counterintuitive, is the rule of debits and credits. When you look at your own company ledger, an increase in cash is recorded as a debit, right? And a decrease as a credit. But think about the bank statement side for a second. When the bank increases your cash, they call it a credit. And when they decrease it, it's a debit. Wait, why? Well, it's because to the bank, your money is actually a liability. It's money they owe you. So when they credit your account, they're just increasing their liability to you. It's absolutely crucial to remember whose perspective you're looking from.
Moving into Part 2, identifying the reconciling items. Time to uncover the suspects causing all this trouble.
First up, let's analyze the items that affect your ledger balance. These are things the bank has already processed, but you just haven't recorded in your books yet. So credit memos, they increase your balance. Think of things like notes receivable collected by the bank on your behalf, or maybe some interest you've earned. On the flip side, debit memos decrease your balance. This is going to be your bank service charges, or, NSF checks, where a customer's check bounced. And finally, book errors. Look, mistakes happen in your own ledger, and those can swing your balance either up or down.
Okay, now let's flip it around and look at the bank balance reconciling items. These are things you know about, but the bank hasn't seen yet. Deposits in transit are a big one. These are cash receipts you've already recorded and sent off to the bank, but the bank just hasn't processed them yet. So we have to artificially add those to the bank's balance. Then you have outstanding checks. You wrote these, you deducted them from your books, but they haven't cleared the bank yet. So those will pull the bank's balance down. And of course, banks are run by humans too, so bank errors happen and will need a positive or negative adjustment.
All right, Part 3, 3 methods of reconciliation. Let's open up the detective's toolkit. Our absolute go-to, the most common tool in the box, is the adjusted balance method. It's like a meet-in-the-middle approach. We put the raw bank balance on one side of the equation and the raw ledger balance on the other. On the bank side, we add the deposits in transit and subtract out the outstanding checks. Simultaneously, over on the ledger side, we add in our credit memos, like that interest we talked about, and subtract debit memos, like those pesky service charges. The ultimate goal? Both of those starting numbers have to calculate down to the exact same adjusted balance. They meet perfectly in the middle. Now, the second tool is the bank-to-book method. Instead of meeting in the middle, we start entirely on the bank side and reverse engineer the math to land on your unadjusted ledger balance. So we add the things the bank missed, like those deposits in transit. But then, to make the math work, we actually have to reverse out the ledger items. So we subtract the collections and interest and add back the service charges and bounce checks. If you do it right, you land exactly on your starting ledger balance. It is a fantastic way to logically prove the numbers tie out linearly.
And the final tool is exactly what it sounds like, the reverse of what we just did, the book-to-bank method. This time, we start with our unadjusted ledger balance. We do our normal ledger adjustments, adding interest and subtracting service charges, but then, to reach the bank's reality, we have to flip the bank items. We actually subtract the deposits in transit and add back the outstanding checks. If your math holds up, boom, that final number will perfectly match the starting bank balance.
Let's put this into practice. Part 4.
Case study time with Sunny Company. We're putting our tools to the real test.
Okay, so here are the raw facts for Sunny Company. Right off the bat, you can spot the central discrepancy. The bank statement is showing 10,000 pesos, but the company ledger shows 12,000. And right along with that, oh boy, a massive wall of unrecorded deposits, uncashed checks, service charges, and errors. It looks like a total mess. So how on earth do we make sense of this?
Well, whenever you are faced with a giant wall of financial data like this, just don't panic. Rely on 3 simple steps. Step 1, identify your base balances. For us, that's the 10,000 bank balance and the 12,000 ledger balance. Step 2, look at every single transaction and categorize it. Ask yourself, is this a deposit in transit, a debit memo? Put it in a bucket. And step 3, just plug those categorized items right into one of our 3 formulas.
And here is the thrilling conclusion, using the adjusted balance method. Notice how on the bank side of the equation, we start with the 10,000 and adjust for their blind spots, like adding in a massive $84,000 deposit in transit. Then on the ledger side of the math, we start with the 12,000 and adjust for our blind spots, like subtracting out service charges. And would you look at that? Both sides calculate down perfectly to a true adjusted balance of 33,000. Case closed, the mystery is solved. Finally, part 5, the matching process. Let's do a little bit of visual detective work with Apathy Company.
Now, if you happen to have both ledgers sitting right in front of you, you can literally do this visually. It's kind of like a game of spot the difference. You compare the bank statement to the company ledger, and you just look for matching numbers. If a $100,000 deposit appears in both places, circle it. It's not our suspect. The items that are left uncircled instantly become our isolated reconciling items. Honestly, this technique takes all the guesswork out of the equation.
As we wrap up this explainer, I really want this core mindset to stick with you. Every single discrepancy between your books and the bank, it's not a disaster, it's just a clue, waiting to be correctly categorized. Once you understand the language of debits and credits, can spot your reconciling items, and have a structured method to apply them, you are in absolute total control of your financial data. So, you've got the knowledge, you've got the structure, and you've got the visual tools to tackle literally any bank reconciliation. My final question for you is, which of the 3 methods, adjusted balance, bank to book, or book to bank, is going to become your go-to tool for your own business mysteries? Try applying one of them today. Thanks so much for joining me on this explainer, and keep learning.